Excellent. All right. Well, thank you for joining today. Today's discussion, we're going to talk about net unrealized appreciation, or NUA as the acronym would be. It's definitely an industry full of acronyms, but net unrealized appreciation, is going to be the key topic of our conversation, and how does it fit within our, kind of financial planning and strategies, pre and post retirement in here. My name is Daniel Evans. I'm a certified financial planner and financial advisor here at Bogart Wealth. I am going to run through a little bit of an introduction, with the firm, so that you are familiar with who we are and the services that we provide. So Bogart Wealth, we are a registered investment advisor. What I like to say in this business, there's really, two sides of the fence to which you can operate on. One would be a broker dealer side, and the other would be the, independent or registered investment advisor. The big difference between the two is we operate under the fiduciary standard, which we are bound to act in your best interest. The other side operates on suitability, which sometimes I liken that to, horseshoes and hand grenades, which, the advice and guidance just has to be, good enough. As a firm, we manage a little over $2.7 billion in assets under management. That's roughly, a little over 1,300 households. When you do engage with Bogart Wealth, we actually custody through Charles Schwab. So we would hold accounts and assets at Charles Schwab, and Bogart Wealth, transacts and acts on your behalf there. We are a comprehensive firm with experience throughout all sectors, and we are a fee-based wealth management firm in there. Our executive leadership team, this is it. I do want to highlight James Bogart for a minute, at growing the resources and capabilities of the firm, along with all of our team. The real testament to that is just the growth that we've experienced within the firm, which is good for those at the firm and good for our clients and relationships that we are engaged with. We do have a full advisory team. These lovely faces here are kind of spread out between, the Woodlands, the Houston area, and then also a team or location in Virginia. This is our portfolio management team. We do manage our investments and strategies in-house. That is led by, Alex Spencer and his team. We do have a full client services team, full, planning team as well, full HR, business development, training, and marketing teams. I do want to highlight these guys. I mean, their effort, they're often behind the scenes, but they make things go for us. Very integral piece of our planning and our process here. 3 offices that, like I mentioned to you earlier. We got one in McLean, Virginia, an office in the Gessner, Houston area, and then here I'm located, and then also here in the Woodlands, Texas. So today's discussion is part of our retirement readiness series. This is based off of feedback from our clientele and prospective clientele that, hey, these are the strategy and topics that, we would like to, receive more education on and have an open, conversation with. So comprehensive financial planning, this is at the core of what we do. Personally, I'm in this chair, I'm speaking to you today is, I wholeheartedly believe that everybody needs to have a, financial plan in place, right? It's not necessarily saying that, hey, this is the plan, this is how exactly everything's going to go. But what it does is it really, draws the framework of our, of our life and our spending and our cash flows over the next, 25, 30, 40 years in there. But when we do look at the planning, I mean, we obviously want to start with a, analysis, running the numbers. We want to look at cash flow, withdrawal strategies, tax planning and optimizations are key components. Investment management, tailored portfolios, making sure that they are aligned, with our risk tolerances and our goals. We do want to look at estate planning and trust reviews. And then, a real key piece here is that review and monitor, right? It's not like hey, we have a plan, we have a strategy in place, hey, we implement it and we're done. I mean, life changes, right? We all get curveballs, and we want to make sure that we're able to adapt and maintain flexibility as we adjust through life with that. So that's why we see this is in a circle pattern, because we're constantly reviewing these within our engagement. Today's agenda, net unrealized appreciation. We're going to look at it, what it is, how it fits into post-retirement. It does fit into a little bit of estate planning strategies, tax strategies. I mean, at the end of the day, this is net unrealized appreciation is a tax strategy. We'll look at it from a cash flow perspective as well. We'll look at it and how good till canceled orders can play a role in how we liquidate those shares if we mean to. We will dive a little bit into options. Specifically, we are going to look at covered calls on those shares and how that may play into our individual situation. So it is important to understand that, hey, as we're working, we're accumulating these assets, and what do we own these in, right? What are the accounts that we own these in? What's the good? What's the bad? So if we look at a qualified account, so 401ks, IRAs, specifically 401k, the good part about this is salary that's contributed on a pre-tax basis, right? We save taxes on a year while also saving for retirement. We're not paying taxes or appreciation as we go. We only have a taxable situations when we withdraw income from those accounts. We're not paying any taxes on dividends, and this is also the vehicle that we receive company matches, as part of our asset growth. Now the other part of it, there is a tax penalty if we take out the money before age 59 and a half. There is a little bit of a caveat to that I will address in our conversation today. But every dollar, that will be taxed as ordinary income when money does come out, when we are making those withdrawals. And, at a point in time, you are making a promise to take out every dollar during retirement, and that is through the required minimum distributions or RMDs. This is where the government enforces that promise, but it's starting at age 73, 75, just varies by, when our year of birth, which one we start taking at, but that is when, hey, the IRS and government says that we have to start taking out funds from these accounts. If we don't, we are penalized for it. There is a substantial penalty for failure to withdraw those assets. And then our custodian, where we have these accounts at, they are obligated to tell the client or tell the government, where that we have not withdrawn the required amount on schedule. We're going to look at the non-qualified account. This is your brokerage account in there. All of these investments are on an after-tax basis. You do, pay more in taxes every year because you have to pay taxes as you go. Any dividends that are paid are taxed even if they are reinvested. If you do have transact and buy and sell in there, you have to pay capital gains on that appreciation in there. And then essentially what they're talking about in the gain is if it's realized, right? Even if we didn't withdraw accounts or draw funds from the account, I didn't sell a stock to, go buy a car, but I sold a stock and bought another investment, that is still a realized gain, and we are taxed on it. And then, as a brokerage account, we don't receive any, a company match in there. The good part is we have access to these funds. There is no such thing as a early withdrawal penalty. We can withdraw at age 45, 58, 57, 72. I mean, you name it. So there is no penalty for a pre 59 and a half distribution there. No such thing as required minimum distributions. If we withdraw, we can, but the government does not enforce any kind of withdrawals from these accounts. And then from a tax standpoint, now we get the opportunity to subject ourselves to capital gains. As long as we hold an investment for greater than 1 year, now we're subject to long-term capital gains rates, which can be lower than your ordinary income rates. So NUA, let me back up here. Oops, excuse me. Back up here. So NUA, what's the deal? We're moving assets from a qualified account, so from a 401k to a non-qualified account, which would be your brokerage account. A couple of caveats on there. This really only applies to your employer's stock within the qualified plan. It can include stock that was received as a company match. And then if we did declare NUA, you do get the option to choose which dollar range or of cost basis that you want to declare NUA on. It must be part of a lump sum distribution from your 401k. It's not like, hey, I can declare NUA and just remove the shares and leave the remaining assets at the custodian. It has to be all done in one transaction. So the first distribution, since a qualified event, which would be those qualifying events would be separated from service at age 55. You've attained age 59 and a half. Your disability, or you have a death in there. You remove everything from a 401k. Like I said, anything that you do not take from an NUA can be rolled to an IRA. Must be nothing left at the end of the 401k. So that's that lump sum distribution. Within the year, it has to be taken out. The balance has to be zero. The benefits of it really we just reviewed it. It gets it into a non-qualified account, and we're really looking at a tax advantage. So why is it called NUA? So net unrealized appreciation, we're basically taking the current value, the market value of the stock minus the cost basis. And that differential in there is what is classified as net unrealized appreciation. It's a tax benefit for the distributed employer stock. And ideally, we really want to maximize the benefit of this by selecting the lower cost-based stock, and we want to have a higher market value of the investment, right? So low basis, high value. That's the scenario that we can maximize the benefit of net unrealized appreciation. The next few slides is really just going to be a visual as we dissect the transaction and what that looks like. But if we didn't do NUA, right, we left all of our assets in a 401k or an IRA. When we pull it out, no matter what the dividends or anything, the investments in there, everything is going to be taxed as ordinary income. When we do declare NUA, the cost basis, the total cost basis, is taxed as ordinary income, but from that to the market value is taxed as capital gains. As we put and then as kind of a display of what we're looking at, here's the ordinary income rates. These are your capital gains rates in there. From a dollar figure, what that looks like, just in this instance, hey, we have $500,000. We left it in an IRA or 401k. We withdrawed it. It's all as ordinary income. And on the NUA side, we have $100,000 that was paid as taxes, but now I've got $400,000 that is subject to long-term capital gains in there. So as we look at this is kind of an example of what a distribution of a 401k would look like. So here we have our savings plan. If we declare NUA, it goes to a brokerage account. All other assets that you have in there would go to an IRA, or if you had other after tax or a Roth in there, it would go to into a Roth. Again, consequently here, this shows that theme that, hey, the NUA shares, we declared NUA, it goes to a brokerage account. Again, if we decided to keep the remaining shares in kind, we didn't want to sell them, then we can roll those over into an IRA, but you do have the option in there that if you want to liquidate it, you could. If you had other assets, if you had a S&P 500 fund or in there, it gets liquidated as cash, and then now you can roll that over into an IRA. Then if you have a Roth component of it, Roth 401k rolls over into a Roth IRA. Again, from just from a visual perspective, sometimes it's easier to understand it when we put dollar figures behind it. But hey, we had a $500,000 NUA that went to the brokerage account. Here's the remaining shares to an IRA. All other assets that we had or other investment vehicles that gets liquidated to the cash. And then again, the Roth goes to a Roth. So if we actually, from an analysis standpoint, right, we're going to break down the numbers here a little bit. So in this scenario, right, here's our cost basis, here's our number of shares, right? So our total cost basis is this $147,500. We have a tax paid portion in this, right? So we're able to apply that in this transaction, but that's $130,916. What that allows us is that we have a taxable portion of $16,584, right? That is the part that is taxed as ordinary income from the basis. In this, and this is just an illustration of it, right? I do want to encourage that we do look at this on a very individual, basis for you. But now and I'm going to put this all together through the next slides. So we look at it, this is our taxable amount as income on the basis. If we drive this example a little bit further, hey, here's my total value. Here's my cost basis. The difference between my basis and the value is my NUA. And in this example, we have $352,500 of NUA in there. That's taxed at a lower rate, at capital gains rate of 15%. And that's the taxable amount that we would owe when we would sell it. Again, kind of the net proceeds. Here's the total value. Here's the tax paid on the taxes paid on the basis, the taxes paid on the capital gains. So our net proceeds with the NUA, $440,491. Now, if we didn't execute NUA, right? So we just had left it in an IRA. We had $500,000 of it. We withdrew it from that account. Well, now we've got a tax in there. And in this illustration, we just chose the 40% to illustrate it, plus, state taxes. It could be higher or lower. But in this event, it all comes out. It's taxed at that 40% rate. Now our net proceeds is $300,000. If we look at that on a comparative basis, the net proceeds with the NUA was the 440,491 versus the 300,000. So our net benefit of NUA is $140,491. Again, I kind of alluded to it when we opened up. I mean, this is a tax strategy, at its core in there. But you can definitely see that it is beneficial. Small amounts, big amounts, if we can execute it, and it fits in the plan, then yeah, absolutely, you want to transact on this. Sensitivities to NUA, right? So factoring in if I want to declare more NUA or when is it more beneficial. If we have that low basis within the stock and we expect, the stock price or the investment price to rise in the future, then absolutely we want to, favor more NUA because that's that gain, more gain that we're subjecting to the long-term capital gains rates. If you need to access funds sooner, right? Or if we're retiring before age 59 and a half, we can use NUA to kind of bridge that gap from a cash flow perspective. Remember, if we leave our assets in a 401k, we retire, we're before 59 and a half, and we go to withdraw those assets, or we roll it over to an IRA, we would go to withdraw those assets, we're potentially looking at a tax penalty. There is an instance in here from a cash flow perspective, and I will touch on it a little bit later. It's called Rule of 55, to where if you're separated from service, age 55 and older, normally you can take a distribution penalty free from your 401k, but it is limited in the amount or then times that you can do that. Normally it's one. I've seen some cases where it's two in there. That I can get 2 transactions per year from my 401k penalty free. And then also, if we're anticipating excess RMDs, right? If we can get money out of our retirement accounts, that lowers our amount that is more now subject to required minimum distribution in the future. Factors that favor declaring less NUA, right? If number one is if we, don't expect the share price to go in the future or to rise in the future. If we don't plan on selling the shares, right? Or instead of, this after-tax contributions, if we rather it go to a Roth account and leaving the stock as is, well, then we don't want to declare it as much NUA. So advantage, disadvantages, you'll see it at the top. And I said it before, the number one thing here is now you're taxed at long-term capital gains rate. So it is a tax strategy. Again, you're not subject to required minimum distributions on the NUA stock. It's not subject to any kind of, withdrawal or tax penalties in there. And you can offset the cost basis with tax paid balance, meaning if I have after-tax contributions in my 401k, I can use that to offset tax consequences on the basis. Disadvantages of it. I mean, the basis that you declare it on is taxed as ordinary income. There's no benefit of tax deferral or any, future growth in there. Now everything is now in that brokerage account, so we're dealing with implications as they go. Significant amount of employer stock does lead less to a diversified portfolio. It's just think of it as kind of a concentrated position that if I wanted to use that. Dividends are taxed at your qualified dividends rate annually, right? That's just part of the paying taxes as you go within a brokerage account. So if we look at it from a pre-retirement strategy, we do want to look at our contributions, right? Pre-tax versus after tax. Of course, we want to maximize any kind of match, but we want to look at it in terms of, hey, do we want to contribute after-tax funds with the purpose of declaring NUA in the future? So we want to look at that ratio. We want to look at the cost basis that we have within the shares, the company stock that we have within the 401k. Do we want to save more? But then I mean, saving more is always a good thing, right? From the financial advisor in me will say that's never a bad thing. So that's always a key component. But we do want to carefully consider, if we want to sell the stock within the 401k plan, we really want to take a look at the basis of the shares that we're looking at selling. I have seen it quite a bit where the default selling mechanism is your highest basis down to your lower basis. So it really protects those low basis shares in there. But we do want to make sure that, hey, we want to be absolutely certain before we hit any kind of sell button that we are targeting higher basis shares versus our low basis, because those low basis shares are the ones that we use to maximize the benefit of NUA. From a post retirement strategy, it does play, a little bit of a plan, and or it does have a stage or a place in estate planning. It is a key component in cash flow strategies under age 59 and a half. Again, there's that word tax strategy. Good to cancel orders is just, hey, how do we want to manage the strategy now, or the investment now that we've moved it into a brokerage account? Same thing with a covered call strategy that, hey, if we do want to sell it, what is a good price point, and can we generate a little more income while we're looking at selling it? So from an estate planning, this is really for your beneficiaries and when they inherit NUA stock. If you're still holding it and your heirs inherit it, they have to pay the long-term capital gains on the NUA. Now the next part of it is very beneficial. But you do have to pay taxes on the NUA, but they do receive the step up in basis beyond the NUA to the date of death of the investment. So in this example, it's saying, hey, we have $750,000. Our cost basis is 100,000. Our NUA is 400,000, right? So that total amount is $500,000. They have to pay taxes on the NUA amount, but they do receive the step up in basis above the NUA. So that would be from the 500,000 to the 750,000 in there. They do receive the step up in basis there. This is just a visual, just trying to drive home that illustration there. The NUA part of it, that is where we are paying the long-term capital gains, but that $250,000 there, at the death, does receive the step up in basis. So cash flow planning, where this has a place in it. is if we are, if we are before 59 and a half, right? How do we fund that gap before we get full access to our retirement accounts? Number one is savings, right? Outside savings accounts, brokerage accounts, other assets that we've accumulated. NUA does play a part because now that we are moving it into a brokerage account, we're not subject to any kind of penalties or pre-withdrawal penalties in there. So how does that coexist with our funding strategy? We could look at, part-time work and consulting. I mentioned it earlier, this rule of 55. If I'm 55, age 55, and I'm separated from service, normally we do have the ability to take a one, I've seen sometimes two per year distributions, from the 401k. But that does put an emphasis on, budgeting and discipline, because if we do have to go back and withdraw, now we're looking at a 10% penalty on top of, regular taxes when we make that withdrawal. A 72T it's you're basically annuitizing your 401k, for a minimum of 5 years up to 59 and a half. I really want to, kind of stay away from this, if possible. But you're annuitizing, so you're starting a stream of income from your retirement account from there, and that can't be turned off for a certain amount of time. Then we could always look at a line of credit. Again, I usually tend not to go that way if we could avoid it. But it is an option that if we do retire before age 59 and a half. So the types of income that we have in retirement, I mean, vary, back from to the whole financial planning, that tax optimization and planning in there. It's very, important and imperative to kind of understand the tax consequences from the different buckets of money that we can withdraw from. I mean, Social Security, partially, up to 85% of is tax ordinary income. Your pension income is ordinary income, interest, ordinary income, any distributions from IRAs, 401ks, as ordinary income, dividend income, hopefully we can get, qualified dividends in there as long-term capital gains, but any others, it's taxes, ordinary income, long-term capital gains rates, Roths. If we do have a Roth component, that is not subject to any taxes, right? So we get the tax-free growth, we get the tax-free distributions in there as well. But then liquidation of investment principal, right? Investment principal is not subject to taxes in there because we've already paid taxes on it. Now this is just a key. This is just kind of a illustration of tax brackets, ordinary income, and the corresponding long-term capital gains or capital gains rates in there. You can see that, and then, if we make over $250,000 married filing jointly, we do have a little bit of a surtax. That's where that 3.8% comes in top of it. So, from 15%, it goes to 18.8 in there, and then added on to the other brackets in there. But this is the corresponding capital gains rates with how my, filing income looks. Good to cancel orders. I mean, really, it's a vehicle that really allows us to control the price point in which we want to sell an investment, right? If I have a price at hey, 110.40, I want to sell it at 120, but I don't. It's almost kind of like a set it and forget it, right? So if I enter a sell order under a good till cancel, that is an open order until it hits 120 or until we go in there and cancel the order. So that's just a way to, kind of lock in a set price, and, because it could take time, right? I mean, it could take a month, a week, a couple days, until it reaches that price point. But that's how we want that. That gives us a little more control over the price that we want to, target from a selling standpoint. Covered call strategies. I'm going to describe this a little bit different than what we see on the screen, but fairly close to it. But essentially, if we have a stock, right, and we believe it's going to go up, we want to sell it, but we want to generate a little more income while we do it. You are selling the right to someone else to buy your stock at a set price. And for that right, they are going to pay you a premium, right? So I'm selling the right for somebody else to buy my stock at a set price in there. As we kind of look from a terminology in there, with the strike price, that's it, which the set price at which we want to sell it at. The time frame, as we look at, we can look at, option strategy, 6 months out, 8 months out, a year out. I mean, a lot of that is variable, but we do look at the options market to determine, hey, does this premium make sense to sell it? Again, there's that word premium. That is the funds that are received from you selling the right for somebody to buy it. And then the underlying stock, right? I mean, we're looking at, the stock price and what we believe it's going to do in there. From a visual perspective, this is just what it looks like. Hey, here's our stock price. In this example, the strike price, which we think it's going to go up, is, hey, I'm going to give you the right to sell it at 120, and in return, they're going to pay me $3, per share. If we look at it from an option standpoint, a one call is at 100 shares. 10 calls is 1,000 shares. 1,000 shares times the premium. So essentially in this example, we have created a $3,000 premium, which is paid to you as income. If the stock does stay under $120, it expires, but you keep your premium. If the stock goes over 120, then it could be called. With that, you keep your premium. The stock is sold at 120. Again, this is just kind of the different. It's just another visual perspective of the transaction of the option. If it goes to 125. Here's your 120 it was sold. Here's your premium. So essentially, you're looking at a 123 sell price. The opportunity cost, I mean, that is the kind of the downside of it is if the stock does go above that, that's what they would call as the opportunity cost at which we would have lost out on. Rather, we held the stock and just sold it at 125 ourselves. The advantages of it, you're earning, additional income while keeping the stock. You do have, a little bit of downside protection in there, but it is a great strategy to generate income if the plan is to sell these stocks, to sell the stock in the future. The disadvantage is the cap on the upside, profit, going back to that example, at 125. Well, I mean, if it went to 130 or 135, even higher, I mean, we basically got a 123 share price, but the stock continues to go. Well, we've missed out on that. You could be required to sell the stock when you do sell that right. And there, a little bit of, downside protection is just limited to the premium we receive, right? So if the stock does go down, we do have, we created income from the right for the person to buy it. As we look at it, as you engage, as we're contemplating retirement, we're looking at our benefits, whether it's NUA. As you look at it, if you want to engage or manage yourself, or if you want to engage in a financial advisor relationship, you really want to look at, experience and qualifications, right? Certified planner is I would consider that a must-have. You want somebody that knows your retirement plan, that's very familiar with IRS rules. You can see that tax optimization and planning in there is a key integral, piece of financial planning that is very impactful on that outcome. You want to make sure that we've navigated multiple business cycles, and has good experience with managing portfolios. Open to discussing various strategies, right? We believe in education. An educated and investor along with us. I mean, combined is a very powerful team. So you want to be open to those different strategies. You want to provide that financial planning based, advice on your needs and risk tolerance. Again, that's having that financial plan in place, right? And looking at the impacts, the decisions, financial decisions that we make. I mean, looking at its entirety and how it impacts our portfolio. And then, as we are mirroring a planning and investment strategy, want to make sure that we have check-ins, we have earmarks that we're looking at it from a portfolio standpoint to make sure that we are, tracking on our goals. And then understandable, right? You want somebody that can speak and understand and have a solid relationship in there. I highly encourage, the financial planning is what we do. And if you haven't been through our process, It's no obligation, no cost to it, but I would highly encourage in engaging in that in manner. Again, I believe everybody needs to have a financial plan to run the numbers to see exactly, where we stand. I would highly encourage a one-on-one session. Again, here's our contact information. We have the three offices, again, McLean, Virginia, in Houston and in the Woodlands. I want to thank you again for joining today. Hope you found this to be informative. NUA, and you have that net unrealized appreciation. You have that. It is a tax strategy, and if you are able to transact and it makes sense within your financial plan, it is one of those things that you really want to take a very hard look into doing there. Again, thank you for your time today. If you have any questions or anything, please feel free to reach out to us. Again, I highly encourage running through our financial planning, process. Enjoy the rest of your day, and we'll talk to you soon. Thank you.